Billionaire Charlie Munger used to say, the first rule of compounding is to never interrupt it unnecessarily. Debt has a funny way of interrupting things, sometimes when you least expect it. Today, we're diving into the debt-to-equity ratio, a simple number that can tell you whether a business is building wealth or quietly heading toward trouble. By the end of this video, you'll know how debt and equity dance together and how that knowledge can help you invest smarter, safer, and with more confidence. Businesses need capital to grow. They can either borrow money, which comes with strings attached, or raise money from owners, sharing both the burden and the reward. Think of it like planting a tree. Borrowing is like using fertilizer. It can speed up growth, but too much, it burns the roots. Equity is like water, steady, patient, nurturing. The debt-to-equity ratio measures exactly how much fertilizer a company's using compared to how much good old water it's got. The debt-to-equity formula is equal to total debt divided by total equity. Total debt means all money the company owes, loans, bonds, lines of credit. Total equity is the owner's claim after all debts are paid, shareholders' investment, and retained earnings. Ratio of 1 means the business uses equal parts debt and equity. A ratio above 1 means debt is dominant. A ratio below 1 means equity is carrying the load. In short, it tells you who really owns the business, the lenders or the shareholders. A sensible investor always checks the debt-to-equity ratio to assess financial stability. Too much debt can crush even the best business. Risk exposure. Debt demands repayment, rain or shine. Growth strategy. Smart use of debt can pour gasoline on profits, but it's a fine line between speeding up and blowing up. Always remember, debt is like a dagger, useful in skilled hands, deadly in careless ones. All right, let's run through a quick example. Total debt equals $500 million. Total equity equals $250 million. $500 million divided by $250 million equals 2. Interpretation. For every dollar of equity, the company owes $2 in debt. That's like walking across a frozen lake in March. Possible? Sure. But you'd better know exactly where you're stepping. Now, a few words of caution before you start swinging that debt-to-equity hammer. Different industries, different norms. A high DE might be normal for banks, but it's a death sentence for restaurants. Short-term versus long-term debt. Debt due next year versus debt due in 30 years. Big difference, folks. Ignoring cash flows. Some companies can handle high debt because their cash flows are strong, like a homeowner with a big mortgage and a rock-solid paycheck. Remember, numbers without context are like a compass without a map. Always think about the full picture. Now, if you're anything like me, you don't want to spend all day punching numbers into a calculator. Good news. There's a faster, smarter way to check debt-to-equity ratios across dozens, even hundreds of companies. Wisesheets makes it easy. Just type a simple function into your spreadsheet, and boom, in seconds you can pull a company's colon, total debt, total equity, and instantly calculate the debt-to-equity ratio across multiple companies. No fuss, no mess, just pure investing wisdom at your fingertips. All right, let's bring it home. Debt-to-equity ratio measures a company's financial risk and structure. A lower ratio usually means a company leans more on its own capital. Always compare within industries and think about the bigger picture: cash flow, management quality, and competitive advantage. And remember, my friend, smart investing isn't about finding the fastest horse. It's about avoiding the ones likely to break a leg.